Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a review of my $29,198.60 stock portfolio. I kind of talked about in my last video how I wouldn't be buying anything, and I haven't bought anything this week. So everything's just kind of grown this week, and I kind of talked to kind of give you the cliff notes in that video. I was kind of saying that I feel like there's a lot more optimism in the market now, but I still feel like there's this uncertainty with the Trump administration and with tariffs. So I think there's the potential for some better deals. If things shift back lower, I'll probably make another video talking about if I'm going to be buying and what I'm going to be buying. I am going to be looking at some specific companies that I kind of have in my back pocket. I've just been really busy lately, so I haven't been able to put as much attention into the YouTube channel as I probably have been in the past. But I just wanted to let you guys know that this is just the amount that it's worth after everything's gone up. So when we're going to start with the Chase account, which is the account that I really am actually putting money into, and this is the account that obviously is going to be growing a lot more than my secondary account that I'm going to be covering at the end part of the video. And I'm just going to be going through kind of the bottom holding and then working my way up to the highest value holding. And with this Chase account, it's currently worth $21,160.12. It has a gain loss of negative $292.95, but that is misleading because that does not include dividends or realized gains, which I am positive for the year on realized gains, and I have gotten pretty substantial amount of dividends, so I'd say we're close to break even. We're also up to $579.70 in estimated annual income, or income from dividends if I don't sell anything, and that's not including any increases in dividends, which are pretty common for most companies every year. Most companies will raise their dividend. So pretty good estimated annual income, especially when you consider some of these stocks in this portfolio do not pay or barely pay a dividend. Now, starting off with the lowest value position in the portfolio, we have ticker symbol TXRH, or Texas Roadhouse Inc., currently valued at $639.09, with a gain loss of $36.70, or 6.09%. But this is also lower than what it actually is because I've only actually invested $600 in. So really, it's a gain of $39.09. I have to say that they did good on earnings. I also just really want to hold this for the long term because I've kind of talked about this in past videos, but I believe that Texas Roadhouse is really going to outpace a lot of the fast food companies just because it's a very similar price point for a much better experience. And I also believe that they're going to be able to open more chains, which is really the thing that matters when you're owning any kind of food chain. That's the biggest problem that Starbucks is having, McDonald's is having. They've achieved this amazing success, and they've done a really amazing thing with their business in terms of growth over the long term. But they're kind of stagnant at this point because there's not really a lot of places where you could open up a new McDonald's or open up a new Starbucks. And I believe that's just not the case for Texas Roadhouse. I think that they're going to be able to continue to open new profitable stores across the country, and those stores are either going to be owned by corporate, which is going to generate more cash flow, or they're going to be owned by franchisees, which is going to generate basically risk-free cash flow for the corporate stock. So I really like Texas Roadhouse. I think that the long-term prospects look good, even if the economic conditions are not as fruitful as they have been. I mean, it does seem like everything's a lot more expensive than it was 5 years ago, but I really like Texas Roadhouse as a business. I think it's very strong. I think that they're very efficient, and I think that they're worth the investment in the long term. Even at this price, I wouldn't fault you for wanting to get into Texas Roadhouse. I might add more of this position, to be honest with you, just because I think it's a very strong business and I don't have a lot of capital in it right now, and I do think over the long term it will outperform the S&P. But there is some risk, again, with those economic conditions, and I'm not a huge fan of investing in restaurants just personally, but I think that Texas Roadhouse really kind of has that edge in terms of being able to grow, so I like this stock a lot. Next up, we have the highest performing stock of the year, Waste Management, ticker symbol WM, currently up 12.38% or $154.72. I'm not sure the exact amount in dividends. It's not a crazy amount that I've gained, but it is a little bit higher than that 154 number. I think a lot of people really rotated into Waste Management simply because they wanted a defensive stock to deal with the uncertainty. I think the best time to buy Waste Management is when we're in a really strong bull market, but I will say that if you want just a consistent return that's going to be a good hold of value, I think that Waste Management is a pretty good buy. Even if you're overpaying when you buy into it, if you hold for long enough, you're going to get your value back. And I kind of think if I come into a very large sum of money, I would rather invest it into a Waste Management and get some good dividends coming in, good growth organically and with M&A. It's just a great company because, I mean, as you know, Waste Management is a waste disposal company. They're very resilient against any type of economy. People aren't going to cancel their subscription to pick up their garbage. Just a very consistent, reliable, slow growth company that pays good dividends and holds its value very well. And I would not be shocked if I would want to add more of this to my current portfolio, even though I think that I'm probably paying a premium for it right now. I think that this is a very strong business that you could hold for your entire life and be very happy with the results. It just looks like the future's brighter and brighter for Waste Management because it seems like every year they're able to kind of leverage their unmatched size and buy more of their competition, increase their efficiencies, and create new ways for cash flow. So I don't think that really the sky's the limit on Waste Management in terms of growth, and it's very resilient to poor economies or whatever's happening in the world. So I really like Waste Management as an investment. I don't really like it necessarily at this price in terms of like valuation, but as a business, I think that it's a very powerful business, and sometimes I think that's more important than valuation just personally. Next up, we have Prologis, ticker symbol PLD. It's currently valued at $1,542.88. I'm up $38.95 or 2.59%. This is also misleading because I really have $1,500 invested in, so really I'm up $42.88. And this is a triple net real estate investment trust, meaning that they do not pay any of the costs for their real estate that they are leasing out. That falls on the renter. And they specialize specifically in warehouse logistics real estate. And the reason that I bought this up is I think that in the long term, warehouse real estate is going to be more valuable. I think it's going to be more imperative for companies that have very advanced logistical networks to be having good warehouse space. And I think that Prologis is just a very smart long-term play because they pay a very good dividend. And then they're also able to use some of their retained earnings to either pay off more debt or buy more warehouses, which I really like. And I really think that the way we're moving with technology advancing better, people demanding better services, quicker deliveries, things of that nature, I think that Prologis is a good buy long term. And I think that it's a very strong company, probably still undervalued here in my opinion. I recently added this about 2 weeks ago when it was below $100 because I thought that it was a very easy buy for that valuation. And I will continue to buy this if it dips below a point where I want to buy more of it. Next up, we have Energy Transfer, ticker symbol ET. The current value in this account is $1,753.54. Currently down 10.29%. Have 101.89 shares. I do have a lot larger of an Energy Transfer position where I believe I'm up over 40% on it in the Webull account, but I still think that this company is very strong, and I wanted to include it in my Chase account as well. Now, if you guys don't know, Energy Transfer is a company that charges a toll, essentially, to move natural gas through their pipeline infrastructure. And there's a lot of reasons to be very happy about Energy Transfer. Some people will say it looks like a value trap. I understand where they're coming from, but what you really have to understand is that it's very difficult to get into this business. It's very inflation proof because once you buy the pipeline infrastructure, that's the price that you pay essentially. I think that energy demand is going up from everything I've seen in terms of the AI data training, new infrastructure being built in the United States and Canada. But I think that the big fear with this stock is that because they do service Canada, there are the tariff fears. They also are a little bit exposed to natural gas pricing. So if oil becomes more expensive, they make more money. And I believe they also own 49% of Sunoco as well. So they do have some exposure to natural gas pricing. Just so you're aware, if you don't want to buy into that, you don't want to be exposed to that kind of risk. But over the long term, I think that Energy Transfer is going to be a very, very valuable company going forward because of the pipelines that they have and also because of just the potential growth. I mean, in terms of like energy demand, I think that we're going to a point where it's going to be very, very expensive. I think energy is going to be more expensive in general, and I think that Energy Transfer is going to benefit greatly from that. Next up, we have ticker symbol Meta. I think everyone knows what Meta is. I currently have $1,778.47. I apologize. With a gain loss of $61.14 or 3.56%. I was down on this a couple weeks ago. I really don't like the volatility of the stock, but I think it offers some good opportunities to buy more. I really think that this stock is extremely undervalued for what it is. I mean, you have a monopolistic company that's going to benefit greatly from AI in terms of targeted ads and things of that nature. I think that they also have a really reliable moat in terms of how much more they understand social media and how many users they have on their social media. I think really their only rivals are TikTok and Snapchat. But it seems like Mark Zuckerberg is very knowledgeable about how to guide this company. And I think that they're actually being extremely undervalued because Wall Street really doesn't understand where the money could come in. For one, you have the chance of them developing the best AI. And I think it's a pretty good chance because they have the best data to train their AI with because they have all the social media posts from essentially everyone. And then you also have that if someone else develops a better AI that can do better targeted ads, they are going to be the best beneficiary of that because they have the most social media companies with the most users for companies to send ads to. So Meta is in a very good spot. I think it's very cheap for what they do and what they are. It's very rare that you can find a very monopolistic company that, in my opinion, has great growth prospects ahead and very high cash flow. I mean, this is just a behemoth of a company that has every advantage in the world. And as long as they make very smart decisions, I think that they are going to be worth a lot more money going forward. Next up, we have American Express Company, ticker symbol AXP. I'm currently up $89.83 on this, or 4.69%. And I was talking about this stock a lot. I really think that this is one of those companies that's just going to continue to be able to grow through network effects and through other means for basically in perpetuity. For as long as I'm alive, I'm going to expect that American Express is going to have improved revenue and improved cash flow. And that's pretty much been the case for the entire time the company's existed, with a few slight anomalies like 2008. I'm sure COVID lowered the amount of spending, but everything has pointed to this company being worth at least $300 a share, in my opinion. And I was even buying at higher because my justification was I want a company that's going to be able to grow basically forever, even if it's not at a super high rate. I think it's very likely that American Express is going to be able to continue to grow into the future, and I really like the growth prospects of this stock. Next up, we have Amazon, ticker symbol AMZN. I currently have $3,039.38, or minus $160.59. So down 5.02% on this, but I think that Amazon is an amazing business. I think it may be the strongest company in my portfolio overall, because it seems like their just subscription service is almost a necessity in American life. They have growing cash flows. They're very intelligent about what they do. And I think that this company really is down because the big money is not patient enough to hold it for the long term. You have to really understand that Amazon is the type of company that's for the investor that is willing to wait out the long term and hold it for the long term. They are investing money into things that may not come to fruition for 3 to 5 years, and I'm completely fine with that. I'm very happy with Amazon as a business. I think it's very similar to another company that I own in my other account, Microsoft, where they have a cash cow business for them, it's their logistical network where they're sending all these packages. That's where they're making their bread and butter. But then they're taking that excess cash and they're able to put it into other high growth projects that bring more equity to the shareholders. So I think that Amazon is a very long-term play, and I think that it's a very strong company that's going to be able to continue to grow, because I haven't had any kind of indication that they're doing anything unintelligent, and it seems like they're really very concerned about growing AWS. They're very concerned about having their hands in a lot of different things that can lead to a lot of potential growth. So I'm very happy with this company, and this may be the best one to be buying. It could also be Meta, it could be some of the next two I'm talking about, but I really think that Amazon has very high potential at this price. Next up, we have Salesforce, ticker symbol CRM. Salesforce, I think, is very powerful just because it has all of the network effects going to it. I also have $3,307.59, and I'm down 10.09% or $371. Almost didn't include that. But I really think that Salesforce is a very strong company because it's very hard to get out of the Salesforce ecosystem. Basically impossible if you're a business that's already in Salesforce. So whatever their current numbers are, they're going to earn that again. And then if they get any potential new customers or their current customers grow their demand for the Salesforce technology, they're making more money. So it's kind of a company that, again, solves the growth problem. How do you grow for a very long period of time? Salesforce has kind of solved that through the fact that you can't really take whatever customer information you have in Salesforce and put it into a new CRM. And to build your own CRM, oftentimes it's much more expensive than just using Salesforce, and it's not as good, so you're not able to compete as a business as well. And they also have a lot of really exciting things coming out, like Agentforce, which I think is going to be very revolutionary in terms of cutting costs for a lot of businesses. And overall, I just really like this stock because I think that it's one of those stocks that's being very undervalued, and it has the potential to get to the level of a Mag 7 stock. And if you look at their revenue over the entire life of the company, it's just a straight line up. So I really like Salesforce for those reasons. I think that it's a very wonderful business. I think that it's a business that I want to own for years to come. And I really think that Salesforce is going to come back. I like it at this price. I will probably... If I'm buying something, I'll probably buy more Salesforce. But again, I'm kind of sitting it out for probably the next month unless there's a really drastic drop. And I'm just going to hold cash and kind of see what happens. But if I was buying anything, I would probably be buying either Salesforce, Energy Transfer, or Amazon right now at these current prices. Next up, we have Vici, ticker symbol Vici. This is the most misleading one in terms of gain loss. I currently have $5,690 worth, or it's saying on Chase a gain loss of $58.57, but this pays me the highest dividend. I only had $5,500 in, so my actual current gain is about $190.83 instead of $58.57. And this is another triple net real estate investment trust, but they own like mostly casinos right now, but they're also buying up golf courses and things of that nature. Really big experiential real estate that they don't have to pay all the fees on, and they have renters that are not going to default on their payments. And when I say they own casinos, I don't mean in the sense that they get to run the casino and they get to have the profits based off of how the casino does. I mean they own the physical real estate of the casino. So they don't own the most valuable part of the casino, but they own the real estate, which is also pretty valuable. And they do get a pretty high dividend payout for that. I'm obviously just collecting the dividend on this. My rule for Vici is that if it goes below $30 for me a share, I'm loading up on the stock. So that will pretty much break my other rule that I'm sitting out. If Vici goes below 30, I am buying hand over fist. I made the mistake of not going all in on Vici and buying some tech because I wanted to diversify. I think that was a stupid decision because I really believe that Vici is definitely undervalued at anything under 30. I think it's probably fairly valued around 34 to 36, but anything under 30, I think it is just completely undervalued. Now we can move on to the Webull portion of the video. This Webull account is just a separate brokerage account that I had before I started my Chase account, and essentially I really don't look at it that often. I did do kind of a special trade this week where I bought a lot of just out of the money calls or one in the money call on Energy Transfer pre-earnings, just as a hedge because I was afraid that the value was going to go up way too much and I wouldn't want to buy anymore. And essentially it worked out. I made about, I would say 50 in profit in a day, a little bit more maybe. I just sold one share of DraftKings, but with the money I was able to buy back my share of DraftKings, buy 2 more shares of Energy Transfer for this account, and then send some money back to my Chase account. So now this account sits with pretty much it's just profits from when I was trading before. There used to be 42,000 in this account, but I sold off a lot of it after I'd made a lot of money in it just because I didn't want the money to be in this brokerage account anymore, and I needed the money because I wanted to buy my car with cash. So you could see here that I have 4.35 shares of DraftKings that are down 5.27%. 5 shares of Microsoft up 3.72%. Those obviously have done a lot better post earnings. I remember just like 2 weeks ago, I was down 10% on them, but I refused to sell because I want to hold Microsoft for the long term because I think it's a great business. And then I have 330 shares of Energy Transfer now, which are going to be generating me about $108 a quarter. And I just take that money and send it back to the Chase account. I thought it was smart to just buy 2 more shares of Energy Transfer with some of the profits in this account just because, that's what I made the money off of on those calls. It was really just a hedge because if Energy Transfer went lower, I was pretty committed to buying more of it post-earnings depending on the earnings, how the earnings went. But it went up and that hedge paid off. I don't really recommend buying options unless you know what you're doing, but this was just a situation where I didn't want to lose out on being able to buy Energy Transfer at a decent price, and I was able to still profit even though the stock went up. And I was able to get some shares for essentially free, just 2 free shares that'll generate me about 64 cents a quarter. So overall, I'm pretty happy with this account. I think that this account's doing pretty good. It just generates me dividend income that I can collect and send back. Occasionally, I'll do an options play here because I don't have the options trading on Chase. When it makes sense, I will buy an options, but I'm usually pretty opposed to it. I only spent like $35 on the options plays that I did, but it worked out pretty okay. But yeah, overall, this account's doing pretty good. It's obviously just based off profits. I don't really look at this account that often, really at all. And I just keep these stocks here and hold them. And that's kind of my full portfolio breakdown for this week. Thank you guys so much for watching. I really appreciate it. I'm really happy with how much the channel has grown. And I think that over the long term, these stocks are going to be worth a lot more. But but I'm just going to kind of sit back and wait to see if we have any short-term volatility. If things go down, I'm going to be looking to add, like I said at the beginning of the video. And if things go up, I might still add a little bit. It just depends on the stock and what I think the fair value is, and if I can get in at under that fair value, because I don't want to be paying the fair price. I want to get some good bargains that are no-brainers. I think that's where you make the most money. And right now, I think that there's a lot of optimism that's come back into the market, which I think things are very near their fair value. I think when I was urging, not urging necessarily because I'm not a financial advisor and it's not financial advice, but when I was making the conscious decision to buy more tech, I think that the tech was really very undervalued, and I think that we're kind of seeing that now. Now I think it's kind of up in the air. I think it's closer to its fair value with a lot of the stocks that I've talked about. I think that some of them are still pretty good buys, but I definitely think there are less opportunities now that the market's come up a little bit from the tariff fears. So I'm going to just sit it out and wait to see if we have more volatility towards the lower side. And if we do, I'm going to be making a play. But until then, I'm just going to save up some of my cash and wait on the sidelines and just kind of watch. I'm not selling anything, so I'll still make money if it goes up. But if it goes down, I want to have the cash available to be able to buy more if the opportunity presents itself to me. So thank you for watching. Please hit the subscribe button if you've made it this far. And I hope to see you guys in next week's portfolio video or my stock analysis videos or the rants. So thank you. Bye.